So hello everyone and welcome back to another video. Today we're going to talk about the S&P 500, and as you can see on the title, the S&P 500 warning, nobody is talking about. So welcome guys, welcome to Selena Your Stocks. Here we explain everything related to stocks, financial market, and also geopolitical tensions hitting on the financial market of the USA. So we cover it fundamentally, technically, and sentimentally. So hit a follow and make sure to like and make sure to comment and let me know if you have any ideas for next videos. I'll appreciate it. Also on the bio you can find our link to our WhatsApp group where we share important advices and tips that would help you in your trading career. So might well you feel free to join us and just send us a message. We'll help you a lot and we'll build in a community there that will make us all have a community where we trade together. So right now the stock market looks incredibly strong. The S&P 500 is near historic highs. Technology stocks continue to dominate headlines, and retail investors are once again extremely optimistic about the future of the market. Even though we saw a small um downward from, let's say, here. So this was last Monday, right? This was Tuesday. We were at 6,847. We were at 6,699, barely 6,700. But on historic levels, we are still on a high for the market. So we're having a consolidation. We went to the last support zone last time and hit exactly our support zone that we had. Then the market went up again. So underneath the surface, something unusual is happening. There is a warning signal developing inside the market structure that most investors are completely ignoring. And historically, when this signal appears, it often happens during the late stages of powerful bull markets. Now, let me be clear from the start. This is not necessarily a prediction about the market that the market will crash tomorrow. Markets can stay strong longer than most people expect, but understanding the risk of developing beneath the risks developing beneath the surface of the S&P 500 can help investors prepare for potential volatility ahead. So, in this video, we will break down why the S&P 500 might be more fragile than it appears. The growing concentration risk is mega cap tech stocks, the market beat, warning signal professionals watch, and what smart money investors are paying attention to right now. Because sometimes the biggest risk in the market is the one nobody is talking about. So one of the biggest misconceptions is investing is believing that the S&P 500 represents the entire stock market equally. In reality, the index is market cap weighted, meaning the largest companies have the biggest influence on the index movement. And today, a very small group of companies represents a massive portion of the index. Some of the biggest drivers include nvda, Apple, Microsoft, Amazon, and Meta platforms. Those these mega cap technology companies have become extremely influential. In fact, a large percentage of the S&P 500's performance over the past few years has been driven primarily by this small group of stocks. That means the index can continue rising even if hundreds of other companies are struggling. This creates what analysts call market concentration risk. And concentration risk has historically been one of the warning signs that appear near the later phases of bull markets. Another indicator that professional traders watch very closely is something called market breadth. Market breadth essentially measures how many stocks are participating in the rally. For example, how many stocks are making new 52-week highs, how many stocks are above their 50-day or 200-day moving averages, and how many sectors are contributing to the rally. In a strong, healthy bull market, we typically see broad participation. That means industrial companies, financial stocks, technology companies, consumer stocks, and small caps are all moving higher together. But when market breadth begins to narrow, it means fewer and fewer stocks are actually driving the rally. Historically, this has sometimes appeared before periods of increased volatility. Again, this does not guarantee crash, but it should suggest the rally may be built on a weaker foundation than investors assume, okay? So, to understand the future of the stock market, we also need to talk about liquidity. Liquidity is essentially the amount of money flowing through financial markets. When liquidity is abundant, asset prices tend to rise. But when liquidity tightens, markets can struggle. So, one of the biggest influences on liquidity is central bank policy. When central banks raise interest rates or reduce stimulus, financial conditions become tighter. This affects corporate borrowing, investor risk appetite, and equity valuations. Even the strongest companies are influenced by these macroeconomic conditions. So, another interesting signal developing in the market is investor sentiment. When markets rise for a long period of time, investors often become increasingly confident. You start to hear phrases like, this time is different, the market only goes up, and technology will dominate everything. But historically, extreme optimism can sometimes appear near important turning points. This happens because when everyone is already bullish, there may be fewer new buyers left to push prices higher. So, professional investors often watch signals that retail traders rarely notice. These include credit market stress, institutional positioning, and liquidity indicators, also volatility markets. So, large institutions manage billions of dollars and often adjust their risk exposure gradually. So, if they begin reducing exposure quietly, it can take months before the broader market notices the shift. So, what should investors actually take away from all of this? First, it is important to remember that bull markets can continue longer than expected, but the signals developing beneath the surface of the S&P 500 suggest that investors should remain cautious and aware of potential risks. Markets move in cycles. Periods of strong optimism are often followed by periods of consolidation or volatility. Understanding these signals can help investors stay prepared rather than surprised, because sometimes the biggest warning signs in the market are the ones nobody is talking about. So, this was all for today's video. Thank you so much for watching, and I hope you guys enjoyed your time. If you have any other questions about the S&P 500, Nasdaq, or any other stock or index in the market, please let me know in the comment section. So make sure to subscribe and yes, send me a message on WhatsApp. I will be there waiting for you to help you and guide you through the financial market in general. So you can ask me questions in there, and I support you throughout your career. So thank you and see you on the next video.